Welcome to Learn Finance. Let's continue our discussion on dividend discount model and how to apply that in a multi-stage framework. In this case, the growth is varying, it's not constant growth, and there are different periods involved backslash. Let's say a company is 10% growing at their dividend is growing at 10%. It will continue to grow for 3 years, and after that it will decline to, let's say, 6%, and after that it declines to 3%, and it stays constant after this. So this is a 3-step or a 3-stage dividend discount model framework. In this, the dividend grows at a rate 10% for the next 3 years and 6% after that, and after that it's a perpetuity thing which is happening. We will apply the Gordon growth model to arrive at all the future numbers, and then we just discount it back here to get the present value, and that will be the value of our stock. In this, we are varying the growth rates, and we can apply the multi-stage dividend discount model. We have these numbers, and then we apply the growth rate here. So in this, our first step is basically we enter the base dividend, which is D0. So just remember our example, which is 10%, 6%, 3%. So this is for 3 years, then 3 years, then perpetuity. D0 is the current dividend. That is our first step to arrive at this number. Then we move to the second step, which is basically understanding what is the supernormal growth period. In this case, we are saying 10% is the supernormal growth. And we need to really make sure that if we are saying 10% is the supernormal growth period, we need to really define it in terms of the period and in terms of what is the growth rate during this. The third step is basically arriving at a terminal value at the end of supernormal growth rate. You know what is the terminal value which really captures the future value as well. So we use it Gordon growth model to arrive at this. The last is basically just discounted by the rate of return or cost of equity to arrive at the present value. So these are the 4 steps. First is arriving at current dividend. The last dividend paid, then we arrive at supernormal growth rate. In fact, we would actually say that we need to arrive at all the growth rates. Even 10%, 6%, 3%, all are required here. It's not just the supernormal growth rate. Along with that, we need to arrive at 6%, 3% the growth rate in perpetuity, and then arriving at terminal. The last step would be basically arriving at present value of all the future estimates, so it will look like D0, D1, D2, and so on. And the last would be the Gordon growth model formula, then discount all these to arrive at present value. Well, overall what we are trying to say is this is D0, which you'll find from profit and loss statement in the income statement, or when you look into the financial statements, you'll find this information that is D0 last dividend paid.